Welcome back to the Pro Ticker Podcast, your Thursday morning edition covering major financial magazine headlines, everyone.
And welcome to the deep dive.
Today, we're going to try and cut through some of the noise, all the financial news swirling around.
Yeah, absolutely.
We're looking at this really fascinating interplay. You've got potential trade barriers, tariffs, then you've got the economic numbers, what they're actually telling us, and then how individual companies are, trying to navigate all of this.
It's a complex picture.
Our mission, really, is to give you a clear understanding of what's actually driving the market right now.
Exactly. And we've pulled together a really compelling set of articles. We've got MarketWatch, Bloomberg, and when you put them side by side, you see some significant tensions emerging.
Like what, specifically?
Well, you have Janet Yellen, for instance, raising red flags, pretty serious ones, about recession risk tied directly to these tariffs.
Okay.
Then you see the Bank of Japan grappling with the fallout from all this global trade uncertainty. And then we'll get into specific companies. Apple, for example, their manufacturing strategy shifts.
Right, the $200 level everyone's watching.
Exactly that. And Adani's huge profit numbers, but there's a crucial asterisk there we need to talk about.
Okay.
So the aim is really to connect those dots for you.
Okay, let's unpack this then. Let's start with the thing that seems to be casting this, long shadow over everything: tariffs.
It feels unavoidable right now.
It really does. Across Bloomberg, MarketWatch, the Wall Street Journal, this word just keeps popping up. It's tied to so many different parts of the economy. It's like this persistent hum in the background.
I'd say it's more than just a hum at this point. It's actively shaping expectations. And like I mentioned, Janet Yellen in that Bloomberg interview, she said it could push the risk of a U.S. recession way up.
Way up. That's pretty strong language.
It's very direct.
Yeah.
Especially coming from someone with her background, at the Fed, at Treasury, it carries weight.
And it's not just hypothetical concern, is it? I saw the Wall Street Journal reported the U.S. economy actually shrank in the first quarter.
It did.
And one of the key reasons they pointed to was this surge in imports. It sounds like companies were literally rushing to get goods in before potential tariffs hit.
Absolutely. That seems to be the story. Businesses anticipating levies and trying to front-run them.
Makes you wonder about the ripple effects, though.
It really does. I mean, this pre-tariff buying spree, you could call it, it might lead to a temporary dip in imports later on.
Right, which could look weird in the data.
Exactly. It could potentially mask what's really going on with underlying demand. So for you, the listener, it means you really need to look beyond just the headline import figures in the next few months.
What should we be looking at then?
Keep an eye on things like inventory levels, sales data. That'll give you a clearer sense of actual consumer demand beyond these tariff distortions. It could tell us a lot about the real strength or weakness of the economy.
Okay, so we've got the tariff threat, a major economic voice sounding the alarm, and data showing businesses reacting. But is everyone agreed on how bad this might get or how long it might last?
Not entirely, no. There's debate. While the immediate market reaction, the volatility, suggests nervousness.
Which we've definitely seen.
Right. MarketWatch has covered that whiplash post-GDP, but the longer-term consequences still being argued. Some analysts think, well, maybe the impact could be less severe, maybe temporary.
Depending on what actually happens with trade talk.
Exactly. Or if some tariffs don't actually materialize or get scaled back.
Yeah.
But the volatility we're seeing, it suggests investors are still trying to price this risk in. They haven't found stable ground yet.
Okay, that makes sense. Now, sticking with that global interconnectedness, let's pivot over to Japan. Bloomberg reported the Bank of Japan decided to keep its interest rate policy steady.
They did.
But what really jumped out was how they explicitly linked that decision back to U.S. trade policy.
Yeah, that was quite striking. How directly U.S. tariff policy is factoring into their calculations. BOJ Governor Ueda, he specifically said these U.S. tariffs have clouded the economic outlook for Japan.
Clouded the outlook.
And he went further, saying this uncertainty has even played a role in weakening the yen.
Wow. So U.S. policy directly hitting the value of the yen?
It seems so. The uncertainty makes investors, maybe less keen on holding yen, right? Demand drops. The currency potentially depreciates.
That really drives home how linked everything is. And it wasn't just the currency impact, was it? The BOJ also trimmed its growth forecast.
He did. They lowered their economic growth outlook and pushed back the timeline for hitting their inflation target.
So they're basically getting more cautious directly because of these trade winds blowing from overseas?
Precisely. It shows how policies in one major economy can send these tangible ripples outwards, forcing other central banks to rethink their own plans and forecasts. These tariff talks aren't happening in a vacuum.
Definitely not. Okay, let's shift focus now to how individual companies are dealing with all this. MarketWatch had a piece on Apple, zoning in on that critical $200 stock price level as earnings approached.
Yeah, that $200 mark. It's become a real psychological threshold for investors, it seems.
And what's particularly relevant, connecting back to our tariff discussion, is the focus on their manufacturing.
Absolutely. The MarketWatch piece went into their potential plans, like expanding production in India.
Right, to rely less on China.
Exactly. Because so much assembly happens there, making them quite exposed if U.S. tariffs on Chinese goods really ramp up. There was also talk about investing more in domestic, U.S.-based component suppliers.
So trying to maybe align with that push for more local supply chains.
It looks like it. Actively trying to de-risk their supply chain because of these geopolitical tensions.
And the article mentioned that $200 level acted historically as resistance?
Where the price struggled to break through, yeah.
And then later as support where it found buyers.
Right, so it's a clear technical indicator people are watching closely.
Why does that become so important in times like these?
Well, when you have big fundamental uncertainties like potential tariffs or major shifts in where things are made, these technical points, these past patterns, they gain significance. Investors are looking for any signal, anything to gauge if the company can weather the storm.
Makes sense. Okay, moving to chips. MarketWatch also covered Qualcomm's earnings. They actually beat expectations, which seems surprising given the tariff fears and the fact that their modem business with Apple is winding down.
It does seem like good news amidst the gloom, doesn't it? Qualcomm's better-than-expected results suggest their diversification strategy might be working.
What are they diversifying into?
They're pushing more into personal computers, the Internet of Things, that kind of area. So even with those headwinds, it looks like they're finding new growth avenues. Shows some resilience,
Resilience is good right now. Then there's Robinhood. MarketWatch reported record deposits for them and a big jump in revenue, even with all this market jitteriness. That feels slightly odd.
Well, it's kind of interesting because market uncertainty can actually boost trading activity sometimes.
People trying to play the swings.
Exactly. When prices are moving a lot and there's no clear trend, more people might try to, capitalize on those movements. Robinhood also said they saw more active traders, and they've launched new things like futures trading.
Expanding their offerings?
Right. Attracting maybe a wider range of investors, giving them more tools. And it's also worth noting, their crypto revenue was up year over year. Even though it dipped a bit from the last quarter, it shows interest in digital assets on their platform is still pretty significant.
Interesting. Okay, let's hop over to India. Bloomberg reported this huge, 753% jump in quarterly profit for Adani Enterprises. That sounds incredible.
Does sound incredible, absolutely. But as always, you got to dig into the details, right?
As catch.
Well, the vast majority of that massive profit increase, it came from a one-time gain, something related to the Adani-Wilmar transaction.
So not from ongoing operations primarily?
Exactly. I mean, it's still positive for the company, obviously, but their underlying revenue actually slipped a bit. And there's a noticeable shift towards focusing more on their domestic operations in India, maybe pulling back a little from overseas markets.
Okay.
And we should probably just briefly mention, Bloomberg also noted that ongoing U.S. Department of Justice probe. That adds another layer of complexity. So yeah, that huge headline number doesn't quite tell the whole story.
Right. Highlights why you need to look past the big number sometimes. Now, completely different sector. Luxury goods. Bloomberg says Citi upgraded Burberry to a buy. First time in 17 years. That's huge.
17 years. It really is significant. It suggests a real shift in optimism about the brand.
What's driving that optimism?
It seems tied to their Burberry Forward strategy. New CEO, new direction. Citi's analysis suggests this strategy has real potential to sort of revitalize the brand, boost its appeal, especially at the higher end of the luxury market where maybe it struggled a bit before.
So a turnaround play, potentially.
Potentially, yeah. Their next earnings report, May 14th apparently, that'll be a really key moment to see if this optimism starts translating into results.
Got it. And then Tesla. Always something going on there. MarketWatch covered their denial of that report. the one saying they started a CEO search for Musk's successor.
Yeah, that definitely made waves. Tesla doesn't often issue those kinds of direct public denials.
And Musk himself was pretty vocal about it too, right?
Oh yeah, very vocal on social media, basically calling the report false. And this is happening while Tesla's stock has had a really rough year to date, hasn't it?
Down significantly.
Right. And there's always that background chatter among analysts about Musk's focus, with SpaceX, all his other ventures, and the potential impact on the Tesla brand itself.
So the fact this story got so much attention.
It just underlines how sensitive the market still is to anything about Musk's leadership role there. He's seen as so central to the company.
Yeah, definitely perceived as integral to their whole identity and future.
Absolutely. The driving force, for better or worse sometimes.
Okay, let's pull back a bit now, look at the broader market picture. The Wall Street Journal pointed out something interesting. Both the Dow and the S&P 500 actually managed to end April with gains.
Yeah, despite that weak GDP number we talked about.
Exactly. They overcame those early declines after the GDP report and even notched up, a 7-day winning streak? Even with that negative GDP print? Seems contradictory.
It really shows how complex the market is right now, doesn't it?
Yeah.
You've got concerning data, but the market finds a way to rally.
So what's the thinking there?
Well, the WSJ piece suggested maybe some investors are reading the administration's reactions, or lack thereof, to market moves as a sign they might be willing to adjust tariff policies if things get too bad economically.
Like testing the waters.
Kind of?
Yeah.
But the article also stressed there's still caution. Some people think valuations are still stretched pretty high.
Okay. And Bloomberg highlighted another trend. Stocks in the S&P 500 are moving together more closely. Higher correlation, they called it. Because of these trade worries, what does that actually mean for us if we're trying to, say, pick individual stocks?
Well, higher correlation basically means individual company performance is being driven less by its own specific story, its earnings, its products, and more by the big picture.
Like the overall market mood.
Exactly. Which right now is heavily influenced by these macro worries trade, the economy. So for you as an investor, it might mean that broad market trends or which sectors you're exposed to could be bigger drivers of your returns than just picking the best individual company.
Makes it harder for stock pickers then.
It does. The Bloomberg article actually pointed out that way fewer active fund managers beat their benchmarks in April compared to earlier in the year. Kind of underscores that challenge.
Right. Now, on a slightly more gloomy note, MarketWatch flagged a report that's apparently gone viral, warning about a potentially long bear market ahead.
Yeah, I saw that mentioned.
And the reasons cited, surprise, surprise.
Let me guess.
Tariffs.
Tariffs and general economic weakness. That report paints a pretty pessimistic picture, doesn't it? Suggesting this recent calm might just be, the calm before a bigger storm.
What are the underlying weaknesses they point to?
Things beyond just the GDP number, like potentially declining corporate earnings expectations, maybe some weakening in consumer spending power, which they argue could get worse with ongoing trade tensions.
So it's just one perspective, but
it's a viewpoint that's getting attention, yeah.
Yeah.
It highlights the level of concern bubbling under the surface for some people. Definitely underscores the need for caution, maybe thinking about your own risk tolerance right now.
Good point. And speaking of downturns, MarketWatch also had a useful explainer on what actually defines a recession officially. It's not just 2 quarters of negative GDP, is it?
No, that's a common misconception. It's a crucial point, actually. The official call comes from the NBER, the National Bureau of Economic Research.
Right.
And they look at a much wider range of things, not just GDP, but also the job market, personal income trends, spending, factory output, a whole basket of indicators.
So a short, sharp shock could still be a recession.
Absolutely. The article mentioned the start of the pandemic. That was a relatively short contraction, but it was so severe and widespread across the economy that the NBER declared it a recession. So, yeah, that recent negative GDP number, definitely something to watch, but it's only one piece of that bigger puzzle.
Oh, okay, good clarification. Now, shifting gears completely, some interesting stuff happening in digital assets. Bloomberg reported on BlackRock, huge traditional finance player.
The biggest, yeah.
They're bringing blockchain tech to a massive $150 billion treasury fund through something called tokenization.
Yeah, tokenization. That feels like a pretty significant step, doesn't it?
What does it actually mean, tokenization, in this context?
So it's essentially turning traditional assets, like the bonds in this treasury fund, into digital tokens that live on a blockchain. Think of them like digital ownership certificates.
Okay. And the benefit is?
Well, the potential benefit is faster, cheaper, more transparent transactions down the line. The article did note, though, that the full efficiencies aren't quite there yet because the official record-keeping still happens in the old systems.
But it's a signal.
Oh, absolutely. It's a huge signal that major institutions are seriously looking at how these digital technologies can, modernize the plumbing of the financial system.
And staying in that digital world, Bloomberg also reported an IPO filing for a SPAC led by Anthony Pompliano. Pomp, right. Well-known crypto guy.
That's him. Yeah, that suggests there's still interest, still capital flowing into the digital asset space, even with all the market ups and downs we've seen.
So maybe more focused interest now.
Perhaps. The fact that someone like Pomp is launching a SPAC focusing on digital assets, but also fintech and asset management more broadly, it indicates there's still an expectation of, innovation and growth opportunities in those areas.
Okay, so we've covered a lot of ground. Tariffs, central banks, company earnings, market trends, even crypto and blockchain. Let's try and tie this together. What are the key takeaways for you, our listener, from this deep dive?
Okay, well, takeaway number one, I think, is pretty clear. The market is super sensitive right now to anything related to tariffs and worries about an economic slowdown.
Heightened sensitivity means more volatility.
Almost certainly, yeah. Expect that to continue, at least in the near term. Second, company performance is really a mixed bag. It's not all doom and gloom.
Right.
You've got companies like Qualcomm, maybe Robinhood, showing resilience, even growth. Others, like Apple, are clearly adapting their strategies to handle the risks. And then you have stories like Adani, where the headline number needs that extra context.
So it really pays to look closely at individual situations.
Definitely. Which leads to the third point. Keep a close eye on those key economic indicators. GDP, inflation, jobs, and company earnings reports. They're going to give you the real signals about where things might be heading. And finally, don't ignore those emerging trends. We're seeing this steady creep of digital tech, like blockchain, into traditional finance with BlackRock's move. And there's still ongoing interest and investment in the crypto space itself. Those areas are going to keep evolving.
So lots to watch. And it really sounds like this period of, let's call it uncertainty and maybe choppiness, is likely to stick around for a bit.
That feels like the most probable scenario right now, given all these different forces pulling in different directions.
Okay. So thinking about all these contrasting signals we've discussed, some solid earnings here, major headwinds there, recession warnings versus market resilience, tariff anxiety. What's the one critical factor you'll be watching most closely in the coming weeks?
That's a tough one. But if I had to pick just one, for me, it would probably be consumer behavior.
Consumer spending and confidence.
Exactly. Because even if businesses stocked up ahead of tariffs, ultimately, it's sustained consumer demand that drives the economy. If we start seeing consumers really pull back, become much more cautious with their spending, that would be a very strong signal of a broader slowdown, almost regardless of what happens with tariffs specifically.
Right. The consumer engine is key. Okay, some really valuable insights there. Thank you.
My pleasure.
Well, that brings us to the end of our deep dive for today. We'll see you all tomorrow morning with new headlines from major financial magazines.